Hey everybody, welcome back. I am here with my friend Chris Barron from AgView Solutions, and we're going to talk about corn and soybean budgets for this year. We've had Chris on several weeks ago. Was that like a couple months ago or more than that even, Chris?
Yeah, something like that.
It
A
might have
couple
been in
months
the
ago.
fall, like October. But in any case, we're going to run through because Chris has some updated numbers for us. We're going to look at some spreadsheets, some budgets. Before I get started, guys, if you like what Chris has to say, check out his website. It's agviewsolutions.com. If you like what I have to say, go to standardgrain.com as always and check out that information. But Chris, let's just start off with this. I mean, big picture. We know that cost of production, corn, soybeans, everything on the planet has risen substantially. What have you learned in your discussions with customers and in your travels and those sort of things?
Yeah, well, there's a little bit of fear out there, and a big chunk of it, I think, is just availability, is making sure we can get the stuff that we need on time. With everything going on in in Ukraine and all of that stuff, I think is a distraction and a huge threat on the fertilizer side of things. And people are starting to figure that out and what the implications of that might be. And that's probably a little further down the road. But I think there's just so much noise going on right now. I think on the farm side of things, we got to just look at what we can control and sit back and make sure our numbers are dialed in. And a lot of operations are going to be planting here real soon, and some of them already are in the south. And so it's just a matter of getting your own house in order, because there's a lot of distraction, a lot of crazy stuff going on in the world right now, and I think we got to stay focused.
Now we're going to look at some updated numbers here, but before we do that, have the numbers in terms of input costs have they changed? Have they changed drastically versus what you thought they would be, say 2, 3 months ago?
I would say there's a couple of categories we'll touch on here in a minute that surprised me a little bit, but nothing terribly drastic. I think people were, um, earlier on, the last time I was on with you, we were looking at a little bit more projected numbers, whereas now we've got numbers that are a little bit more realistic. I think, though, there are still some numbers like crop insurance yet that's not completely decided on, dialed in. LP for drying corn and natural gas and fuel that's not yet locked in. There's still some operations that have some things up in the air yet, just because some areas you just can't lock in anhydrous, for example, or some areas you can't lock some stuff in yet. So we still are seeing some unknowns. And then again, back to the supply chain disruptions of whether it's parts for machinery and equipment or whatever it is, there's still enough unknown that our numbers are far from being exact. But I think I feel way better now of where we've got things dialed in. I'm pretty optimistic.
On the fertilizer side, and with some of these other inputs, I think you had told me before that you've got a lot of customers say that maybe have it booked on paper in that they've booked a price for fertilizer and for some of this other stuff, but maybe they are still worried about actual physical delivery. Is that still the case here?
Yeah, it is. I mean, the anhydrous could be an issue on some of the pre-plant in certain areas because there was so much fall applied done. I think just in talking to a number of operations, their suppliers are telling them, be patient with us and we're going to do the best we can. But, there's only so much logistically that can be done, as far as moving stuff around and getting things where it needs to be. And the other thing I would say too is just, everybody's having the same kind of labor constraints. And so from a logistical standpoint, just moving all the massive amount of stuff from the agricultural inputs that we have from point A to point B, a lot of these would-be truck drivers can make a lot of money doing other jobs now and not have to be away from home and things. And there's a lot of these transportation companies and stuff that are really struggling trying to get a hold of labor. And so I think, we're going to have to be on the ball on the farm side of things and have things in as quick as we can, like crop protection and things like that. If you can get that stuff on site, seed's not as big of an issue. But the crop protection and any of the fertilizer, especially the nitrogen, the 32%, 28%, those kind of things, I think anything we can get on the farm, I think is advisable to get it in-house ASAP.
We're going to throw the numbers up on the screen here real quickly for those of you guys watching or listening. If you don't farm, the general idea here is that prices of corn and soybeans are drastically higher than they have been in recent years, but we're seeing a drastic increase to the cost of production for both crops because of logistics issues, supply chain issues, inflation, all of those issues. So that's kind of what we're addressing here. So let's throw your PowerPoint up on the screen here, and Chris sent me this today. Corn and soybean financial policy. You want me to just get to the first page here?
Yeah, that'd be fine. This is as of 3/12, so basically, as you know, it's as of this date now with the data set that we have.
Very good. And we're recording here on Friday afternoon, just so you guys know. You will see this on Saturday. So here's our first page: corn versus soybean comparison, 2021 to 2022.
Yeah, I'll start out just kind of Joe at the top there. When you look at what is the cost increase from 2021, inflationary from 2022 on soybeans, we're looking at about $92 an acre more to put a soybean crop in as a whole versus last year. And on the corn, we're looking at about $215 an acre more than last year. At the same time, with essentially the same inputs. I'd say that's about as relative as you can get in terms of comparison that's true. Cost of production increase that we're seeing, the soybean cost of production increase is up about $1.39. Corn is up about 94 cents. When you look at that in terms of a inflationary component on a percentage, soybeans are up about 12% to put a crop in versus last year. So the inflationary cost increase on the inputs on what we see currently right now with real numbers is at 12% on soybeans and about just shy of 20% on corn, with nitrogen and a couple of other key things kind of being the big driver there, which we can talk about in a minute. The other thing I would say though, and if you can see, if you're watching this, if you're not, I'll explain it. But what we did with this initial report here that you're looking at is we normalized it with 1,000 acres of corn and 1,000 acres of soybeans. And if that's the situation, if a 2,000 acre farm has 1,000 acres of corn, 1,000 acres of soybeans, you're looking at $308,000 or $307,000 more working capital required to put the crop in on a 2,000 acre farm, corn, soybean, 50-50 rotation.
Hey, Chris, real quick. These year-over-year increases we're talking about, 12%, 19.6% for corn, $1.40 for beans, 94 cents for corn. Is that the biggest year-over-year increase you've ever seen?
Yeah. From 2008 to 2009, we saw a really big increase that year as well. Especially on corn that year, we had a big jump in anhydrous prices and stuff, but it was closer to about somewhere between a 13 and 15%. So as long as I've been doing this is what I would classify as almost hyperinflation.
Yeah.
Because I've not ever seen it go up this much this fast.
Well, most people would characterize 19.6% as hyper, I would say.
Yeah. So like I said, it was pretty steep in 2009, coming out off 2008. Those inputs were up there, and it took a little while for those to come down. And then we saw the same thing again, obviously 11, 12, and exiting 13. So there was a period of time there too, but I didn't see it quite this extreme as what we're seeing now.
One of the issues, of course, is that inputs go up, but they don't come down quite as fast as markets, or they don't come down at all. How much did you see inputs go down, like after those those steep increases back then?
It took basically 3 years to bring it back to neutral. We saw the first 2/3 of it come out in about 18 months, and then the other third was real slow. That's kind of vague way to put it, but it does drop fairly quick on the front end, but you don't get all of it back. You get maybe a third of it back, and then that decline and the input cost price really slows down. So
Yeah, that's not a surprise to anybody, I don't think. All right, so your next price outlook estimate.
yeah, so basically that next line that we're looking at is where our clients are at currently, cash on farm estimated sales price. We're at 1331 on soybeans and 559 on corn. Again, you can talk all day about, well, maybe we should have waited and sold today, I guess, because it's higher now than what those risk management sales were. But I'm kind of like you, Joe. I think, if any of these operations that we work with were to do it over again, they'd still make those sales because you have to mitigate risk. And when you were buying anhydrous or nitrogen or fertilizer or whatever input you were buying, you kind of had to offset that increased price with a sale along the way. I don't have that number in there, but currently right now, our data is showing our clients are at about 38% sold both on corn and soybeans, pretty much the same number, slightly a touch higher on soybeans, about 39% on soybeans, about 38% on corn. That's using the data that it's in here. It shows an average yield of 62 bushel on soybeans and 212 on corn. The operations really in this database range from north to south, east to west, across the corn belt, and we've got some North Dakota and South Dakota numbers in here too. So, just to kind of give you some perspective.
It's a good sample size.
Yeah, so it's a large sample size. The 2022 cost of production estimates, then we're seeing soybeans at 1139 and corn at 482. The big thing there, though, again, is you're looking at $1,020 to put a corn crop in and about $711 to put a soybean crop in.
Hey guys, real quick, if you guys are listening and you don't farm, it was only a couple of years ago where most farmers would have killed to sell corn at $4.50, and now it's going to cost $4.82 just to produce it. And the same thing goes for soybeans. I mean, farmers would have killed for $10.50, back in that whole time frame from, say 2015 through most of 20, and now it costs more than that just to produce the stuff. So the inflationary effect here is pretty profound.
Well, and keep in mind too, Joe, this is an average. So the range is what's really interesting too. We've got a number of producers in that data set. The cost of production's in the 540 range on the high end on corn, and then we've got some that are in the low fours. So there's a pretty good range in there too.
Yeah.
Depending on where they farm, what their yield production opportunities are and things. But the other interesting thing in this chart before we go to the next one too, Joe, is 2022 net income, corn versus soybeans. Corn is still about $40 an acre better than soybeans in our average data set. Now, that's not to say that, I was just in Missouri earlier this last week, and some of those operations, it makes more sense to plant soybeans, and there's certain areas where soybeans are more profitable depending on how the yield is in corn versus soybeans. That's the biggest driver, whether or not a farm's going to move. I think a lot of times we get really focused on the market corn to bean ratio, but there's also a yield corn to bean ratio that affects that too. So those two things in concert really dictate what the producer probably needs to do. And again, this tool, if anybody wants it, we'll gladly send it to you. You can email us and we'll send it out to you, and you can run your own numbers and see what your own situation is.
Guys, in the description here on the YouTube video, I'm going to put the link to Chris's website, and you can get a hold of him through that.
Yeah, and we'll put Shay's email on there too. He'll be the one that would email them back out to everybody. So
sure. So ROI estimate, I mean, you're pretty close at 16 to 17% for both crops.
Yeah, and ROI is a little bit, you got to be careful looking at return on investment. You still have to really pay attention to that net income per acre especially when you compare corn and soybeans, because you got a lot more dollars invested. And we'll hit on the insurance in a minute too, but I've got a number of guys that are looking at, with where the insurance number's at, you can guarantee a pretty good return on investment with where crop insurance is at right now too, especially on the corn side, in the areas where the yield the yield projections are quite high. You know, if you're in an area where you're paying high rent and you got the potential for high corn yields, you pretty much, I don't think any of those guys are going to be switching to soybeans anytime soon.
Right. I got you. All right. You want to go to the next page? You got
Yep.
anything here you want to cover?
No, we're good.
Okay. Okay. This is a lot of numbers. Tell me what's important.
Yeah, so the important stuff here is, I guess, first of all, that return to management category. If you want to put your little red dot there on that top line, it says return to management in that 23%.
Where is that?
Down.
Oh, I see right here.
Yep. So go across there. 23%, well, actually 24% now is the percent increase that we're seeing now on return to management. Again, what is return to management? Return to management is all of your overhead costs. It's your draws. It's what you pull out of the farm for paying yourself. It's what you pay your employees with. It's electric bills. It's vehicles. It's paying gas. It's paying for college for the kids. It's anything that is an overhead expense that's part of the cost of doing business. Last year, that number was around $64 an acre. This year, it's right around $78 an acre. That's basically a 24% increase. Of that number, to the best of my ability, and this is not an absolute statistic, but we can go back in and we can kind of correlate where those dollars are. And when we all make more money, we tend to spend more. So part of that increase in that category is because we're spending a little bit more money on stuff. But the inflationary component of that, somewhere, to my best estimation, somewhere between 17 and 19%. I'll guarantee you it's over 15%. I know that for a fact. It's hard to dial that in exactly to where it is, but my best estimate is we're somewhere between 17 and 19% inflation increase in our overhead expenses, because that's, it's the food bill, it's buying gas. I just put diesel in a pickup the other day, and normally it would have been about $90. It was $150,
right,
just to fill, just to fill up with diesel. So, all those things are starting to really add up. So that's the first category that's kind of a sticker shock. The other one is kind of a mentionable is land, which is the very next category there. What we see there is basically up about 11%. We've seen some landowners and some of the big landowning companies starting to try to want to negotiate or to reanalyze some of the variable lease agreements and stuff. I mean, I think as farmers, we got to be
shocking news.
Yeah, weird, huh? So we got to be really careful there, though, because that 11% is actually higher than that in some, like I talked about, that range. I mean, we've had some farm operations where their rent went up $80 or $90 an acre, but we also have some that stayed exactly the same. And we also, when you look at that 11% number, that includes the land you own plus the land you rent. You take the amount of dollars that you spend on your principal and interest payments on the land you own plus the cash rent you pay. You add all that up and you divide it by the acres you farm, and that's what that number is. And in our data set, the average is $282 an acre for land. That's up 11% from last year. The range is huge. I mean, I think on the high end, there's some low 400s in there, and on the low end, there's some, there's literally some in the low 100s. And so
again, this example is 1,000 acres of corn is what we're looking at.
Yep. And that's why I said, to normalize the data, what we're really looking at here is the percent increase. And that's why I said, if anybody wants to put their own numbers in this tool, what we're really looking at is what's the inflationary impact. How's that going to affect the pulse of your business, as you look at this inflationary component.
Guys, that's the whole idea with what Chris does, is that, like, these are sample numbers for, demonstration and just general data purposes. But the whole idea is that your own numbers are the ones that really matter to you guys. This is a sample, but this is not your numbers. And the whole point of this exercise and what Chris does is to get your numbers into this spreadsheet, basically.
Right. Yeah. And like I said, well, if anybody wants the tool, they can put their own numbers in it. But one thing I would tell you that I think is pretty darn accurate are these percentages in that category we have highlighted. I think that's I mean, the range in those percentages is pretty tight. What we see is range differences in certain categories, but the percentage increase. So, for example, if you go to crop insurance, that's a bit of an estimate right now. We're estimating that being up about 22.5% or so.
Yeah.
Part of that is some people are reducing the level of coverage a little bit. Some are keeping it the same. I would really caution people, if you're lowering your level of coverage, make sure it's still covering the risk that you have on the table, because there's a lot of risk obviously there this year. And we got to be careful not to look at what we write the check out for as much as look at what is that insurance cost on a per bushel basis. Another category right below that, Joe, is fertilizer. Most people have their dry fertilizer either paid for or secured or already on. So that number is right at about 48%. The big one is the nitrogen. That's up about 143% in our data from last year. That's the biggest single line item percentage increase of everything, is the nitrogen. Hands down, it's a big one. You look at that. The other one is herbicides and fungicides. They're up just shy of 20% from what we see, and availability of glyphosate and some of that other stuff still a huge issue in a lot of areas. And then the other big unknown, we have 24% down there on drying and expense, 24 to 25%. That's just plugging in kind of what we know now versus what most of these guys used in the last couple of years. So if you just looked at what you spent last year and take 25%, with what we know now, that's kind of the inflationary component. So,
yep. Okay. So cost to grow corn up 20%, pretty much.
Yep.
If you want to average it out overall.
Yep.
Okay. Is your next sheet soybeans?
Yep. You can hit that one next.
Okay.
Kind of the same thing. Don't have as much to hit here because we just talked about the return to management category up 24%, basically all your overhead costs. Fertilizer is kind of the same deal, that 48%.
Yep.
We've seen a few guys cutting back a little bit on soybeans. I'd be super careful, treating your soybeans like the stepchild or whatever. The yield, the fastest way to lower your cost of production is increase production, increase bushels. And so I think we got to be really careful that we're not skimping on fertility. We're not skipping on the quality of the seed. We're not skimping on the right, fungicides and things that we need to do. Anything we can do to increase yield or enhance yield, I think is real important. So I've seen a few people trying to cut some corners. I'd be real careful doing that. If you're going to cut corners, don't try not to cut them on anything that either enhances or improves yield. And then kind of the same thing, when we go down and we look at equipment costs. I didn't hit on that one. On the corn, doesn't matter. I'll hit on it now. A lot of the equipment manufacturers are advocating an additional 10% price increase. So, if you think about, if you have for example, you have a $400,000 purchase that you're looking at for, 2022 or going into 2023, just the price increase alone is $40,000 on a $400,000 increase. And last year we saw a 14% increase on new equipment. So, in the last, so when we get to the middle part of this year and we'll have seen a 10% increase in machinery and equipment, that's going to be a 24% bump in machinery and equipment cost. I'm only showing a 10% equipment cost increase there because it's a direct correlation to what the producers are spending and how they're dividing that capital out over the acres they have. But I think we also need to keep in mind that even though that shows 10% this inflation, and when these new pieces of equipment go up, they don't come back down. So we have to be real careful to make sure that we're quantifying the machinery and equipment accurately, because that cost is a real cost. And just because you aren't buying anything this year doesn't mean that inflationary increase isn't going to catch up with you in 23 or 24 when you do have to buy something. So I think we got to be real careful in how we analyze that. And that's something, if people want to call us one-on-one, we can talk through how to analyze that piece on the equipment a little dialed in better.
So total cost of production in beans, you've got up 12% year over year, which is not as bad as corn, mainly due to the nitrogen issue, I suppose.
Yeah, nitrogen's the biggest deal across the board.
Mm-hmm. Okay. Do we have another slide here?
Nope.
No, here's all Chris's information. Anything you'd like to add, Chris?
I think the biggest thing is, again, is everybody, all of us as farmers, just making sure we sit down right as we are going into spring and have a pretty good idea what our cost of production is individually, not somebody else's or not a university average or not mine, your own. Know what that is and pay attention to people like you, Joe, because I've heard you say a lot. You do a great job with your subscriber only videos and stuff to make sure you're getting that pertinent information out there. And I think we all got to pay attention to that stuff, because a lot of times when the market opportunity is there and when it goes away and we look back at it, there a lot of times wasn't very much time to make a decision. And so I think we need to know what that margin target is. If we know our costs, we can say, okay, our profitability target is maybe it's 15% ROI, or maybe it's 18% ROI. And are you going to hit the high in the market? No, you won't, but you will stay in business and you will do really well. My biggest fear right now is the same thing that happened in 2012. 2012 screwed up everybody's mind in how we market, because the price went up and everybody got greedy. And then when the price came back down, it was too late to fix much. Yeah. And so I think we just got to keep our heads on straight. And again, listen to people like you. And when the opportunity's there, we need to manage the margin, and instead of trying to hit the higher price, pick a margin target and let that dictate the decisions. That's my 2 cents.
Yeah, the thing with markets is that when they do go down in an environment like this, they tend to go down a hell of a lot faster than they went up. And that's what makes it tricky, because you can, without getting into a marketing conversation, I mean, you can get that like deer in the headlights mentality where things just happen so fast that you're afraid to make a move. So this stuff is real important, guys. I mean, knowing your numbers, knowing your cost of production, knowing your margin targets, all of that stuff. Do you have any quick comments on 2023, Chris?
Good question. We've seen a few people pull the trigger on a little bit of 23, and we have a couple that have pulled the trigger a little bit more than a little bit, and mainly because they're operations that have a lot of fixed costs. A lot of their costs are already known. The only unknowns really are the fertilizer. So if you know that you have, if you own the majority of your land, you own your machinery, and you have very little debt, these opportunities are really massive for profitability that's just unbelievable. So it's an individual decision as to, because I've heard some people say, well, don't sell any 23. I've heard some people sell a little bit. I think you need to look at your own individual situation. And if your expenses are very dialed in, because we've got some clients that have 75% of their cost of production already dialed in for 23. Well, they can sell a lot more than the person that's cash renting everything and has no clue what the rent's going to be. So I think that's a very individual decision. Although I would say that if you've got a lot of those expenses locked in, the opportunity is there like I've never seen it before, that far out. And I'm not sure what would hold one back from taking advantage of some of that profit opportunity.
Only thing that would scare me, I mean, just from a risk management standpoint, I have no clue what the 23 markets are going to do in terms of price direction, but who's to say that the cost of production for corn couldn't be up another 20% next year? I mean, this inflation deal doesn't appear to be going anywhere. That's a different conversation. Yeah. Hey, Chris, thank you so much for coming on. We'll do this again sometime soon. Guys, all of Chris's contact info, it'll be in the description on the YouTube video. It'll be in the description on the podcast. And if you need some info from me, just shoot me an email. info@standardgrain.com is my email. I can put you in touch with Chris or Shay. Chris, we'll see you later, buddy.
Sounds good. Thanks, Joe.